The biggest part of the scene, I think we'll just spend a minute, was what we had. You guys might have experienced a similar thing. We had the most extraordinary set of fires this year in living memory, and it was extraordinary to the extent that we actually had one day without sun. It was. It will truly be remembered by all of us. It was straight out of one of those movies of global apocalypse or landing on Mars. The sky in the morning was orange red, like so orange red. Everyone was going out of their homes looking at it. It was so dramatic. And by noon, there was so much sunlight, you had to have your lights on in your house. And if you were driving, you had to turn your headlights on. There were so many fires burning around the San Francisco Bay Area that it truly gave you a little window into what would happen with an asteroid strike or kind of a nuclear winter, where the effect is all that soot in the air blocking out the sun. You could really feel it in a very tangible way. It was quite an event for us.
Yeah, well, we did start our year with some of the worst bushfires that we've ever had. So from November through to February, we had terrible bushfires. In fact, when they started the bushfires in New South Wales, I was in New Zealand, and we had smoke, so much smoke in the air in New Zealand from the New South Wales bushfires that everyone was being careful about going outside. And all up and down from the East Coast here.
Yeah, we had 2 weeks of advisories where anyone with compromised breathing or COPD was told not to go outside.
We're
about, we have 28, Jordan.
Yeah. So I'll just start by welcoming everybody to Angels at Noon with Melbourne Angels. For those of you who don't know us or haven't been here before, we're an angel group, which means we're a group of private people who invest our own money in startups with the hope of making them hugely successful and turning the world into a better place step by step as we do that. Now, what we do, we couldn't do if we didn't get some support. So we'd like to thank the organizations here who give us the support to be active as angel investors. So just very briefly, Melbourne Angels is one of the most active startup investors in the country. We typically do in excess of 20 transactions a year, and that's usually $3 million or maybe even a bit more per year. We currently have over 85 members, and in the 13 years we've been running, we've invested now, or our current portfolio, I should say, is in excess of 75 companies, and we have 22 deal meetings every year. So we meet twice a month to have entrepreneurs and founders pitch to us. Over the years, that's added up to more than 600 individual investments by our members and over $30 million of direct investment. Those companies have attracted additional capital into our rounds of investment. So all up, that's around about $180 million of additional investment into those companies. And that's one of the powers of angel investing, that the first angel group that invests almost always attracts other co-investors into that round or immediately after. We're very proud of the fact that our investments have funded in excess of 600 new highly skilled jobs, and many of those jobs stay in the community. And we've had 7 exits up until now, and one of those was an ASX listing. And one of the others that we had late last year was an award winner. But just very briefly, why angel investors and why Melbourne? Well, in Australia, depending on how you count, but in Australia, on a list I maintain, we've got about 17 unicorns, that is, companies that have reached over $1 billion in valuation. Of those 17, 10 have been angel backed, 11 were founded in Melbourne, and 6 dominate their industry globally. So if you're thinking about being an angel investor and you're interested in looking for the big wins and you're wondering where to go to do it, I'd suggest that Melbourne is a really good place in Australia to be making those early stage investments. And it's also worth understanding the pattern of what the exits look like for angel investors. So when we look at the M&A exits in Australia over the last 3 years or so, that have earned more than $5 million in transaction value, you can see that the vast majority of them have been angel-backed ventures, and just under half of all of those were founded in Melbourne, and a very large proportion, 85%, had no VC investment. So it's really important to understand that startup investing is not a pipeline. It can be, and in some sectors, like the one we're going to talk about today, it is more common, but it's certainly not the norm that every startup that we invest in is going to go on and raise venture capital. And it's certainly not the norm that without raising venture capital, you don't get an exit. And it is worth, that last one, of course, is really important, that the biggest returns to founders and early stage investors, the vast majority of those happen in the companies that do not take on venture capital. Venture capital funded companies tend to have the largest value exits, but an enormous amount of that value is captured by the later stage investors. So that's just a little sort of perspective on why we do angel investing and why Melbourne's a good place to be doing it. So we do invite anyone who's with us today who's thinking about maybe getting in on angel investing to consider joining us. And if not you, if somebody you know, then please do consider joining the Melbourne Angels. We're an all-volunteer activity, but we do what we do to help the founders succeed, and as I said, to make the world a better place. And we do this every month. When we get back to being allowed to gather in large groups, we'll go back to having this as a lunch. But for the time being, we're doing this every month. The next one's at the end of November, rather. And you can book through Eventbrite, and we will do our best to sort out the conundrum of getting into the meeting between Eventbrite and Zoom. So with that, what I'd like to do is just briefly introduce our guest speaker today. Allan May is the founder and has led the Life Science Angel Group in San Francisco Bay Area, based down in the peninsula. And he started that and has been running it and leading it for many years. It must be getting close to, is it 18 years, Allan? 16. 16. So for 16 years. And I've been fortunate to know Allan for almost all of that time. And he's a great guy, and he's been a significant leader in the angel community more broadly. But one of the things that's really significant is that life science angels figured out early on that investing in life science is different. There are things, characteristics of the sector, the regulatory aspects, the long gestation time for a lot of the products and services that can be developed in that space that needs a slightly different model to the one that we might use to invest in a straightforward software company or a digital technology of another ilk. So Allan's going to speak to us today from his experience. Life Science Angels was recognized for a number of years as the most active angel group in the United States, and continues to be, if not the, certainly one of the top two, I would say, life science specialist investment groups in the world. So with that, I'd like to hand over to Allan to share with us what you will.
Thanks, Jordan. That was a very nice introduction, and I appreciate it. It's really nice to meet all of you. I've been fortunate to have a couple trips to Australia when they were setting up the AAAI and some of the early things we worked on, and I have had a fantastic time every time I've come down there, and really enjoyed the trip, and especially the people. It's such a fun group to hang out with, and I think a number of us have become quite good friends as a result of those early minglings. So very glad about that. Let me follow up. First, I want to make this as interactive as possible, and so please just dive in with questions or whatever you have. What I was thinking of doing was spending just a few minutes amplifying what Jordan said about Life Science Angels, maybe then spend a little bit of time talking about what's going on in medtech and healthcare, and give you our perspective on that, and then talking about, then highlighting a couple of issues, themes that I think are sort of the hot items, and let people then take it whichever direction they'd like, if that's all right with everybody. So we are 16 going on 17 years old. We, very similar to what Jordan described, we invest about $4 or $5 million a year. We've done that consistently throughout that period of time. We've got about 130, 140 members. And in general, we function pretty much like the average angel group. We're member organized. We have, there's no paid people in the group. Everyone does this on a pro bono basis. And we do it because we expect our colleagues to do it too. And it's the camaraderie of the effort and the consolidation of expertise and networking that really is the advantage of the group. The one thing maybe that we pioneered, not pioneered, but certainly amplified a bit, was the idea of sector investing. So as Jordan mentioned, the more or less typical angel group invests in whatever they've got. Maybe it's software, maybe it's clean tech, apps, or medtech, a little bit of everything. We thought earlier on that one of the differences in life science investing from other types of investing was that even when entrepreneurs and innovators spot a terrific need and develop a very cool solution that they can build and implement, which in fact addresses that need, it's nevertheless illegal to sell that in life science. You have to go through the regulatory pathway, and there's a number of things that then chew up a bunch of money and a bunch of time and add additional risk. Then you actually run into the issue of who pays for it. And what it turns out is, unlike every other sector in the world, most people don't pay for their own health care. And so you run into a phenomenon where the patient getting it didn't pay for it, and the physician using it didn't pay for it, and the hospital buying it actually didn't pay for it. In the end, it's payors, either private or public, who fund these things. And so you have a multi-sided market where you have to have value propositions, not just for each of them, but for a half a dozen stakeholders at the same time. So it's a more complex business model than some other sectors. As Jordan, I'm sure, has mentioned in the past, one of the few things that has correlated to investor returns is sector expertise. And it is relatively clear that the more individuals in a group understand about particular sectors, particularly if they've been in those sectors themselves, the better their returns are likely to be. And probably that's because they're better able to do due diligence at a more sophisticated level within those sectors. So we came up with really concentrating hard on the major four categories in life science: medtech, tools and instruments, diagnostics, genomics and biology, and digital health. There are actually, if you dig into it, there are actually 30 or 40 subsectors within there that are very dramatically different from one another. You know, that includes things that go from MRI machines all the way down to the needles that nurses use to give you drugs. They're still all medical devices. So it's actually a hell of a broad sector, but within that, we focus within those four verticals. Almost everyone in our group is from those verticals. And in particular, what I mean when I say that is not that they were consultants or lawyers or bankers in those verticals. Rather, they were operating people. So the majority of our members, the typical life science angel member, took a technology from the lab, from the university, from the actual invention and commercialized it through the regulatory process onto the market and sold that company. So they've translated those inventions and innovations from the idea stage all the way to exit. And that gives us the ability to really look at the commercial pathways that these technologies face, and to be able both to provide assistance and advice there, as well as to understand the risks that we're taking when we invest in certain of those things. So it's sector specific investing. We don't invest outside of life science. In addition to that, when we do invest, we create special purpose vehicles for the investment. So we've figured out a way to do this that doesn't require you to create new structures for every investment. In fact, we can run the overall parent structure for a year or two typically, and still do multiple investments within that. But the idea is simply that each of you decide, do you want to invest or not? And each of you decides, if you want to invest, how much. That's on you. After you do that, the money goes into the special purpose vehicle, and the special purpose vehicle writes one check into that company. The reason we do that is, first, it gives us enough cumulative mass in the deal to help drive terms. We're able, in a number of cases, to lead deals, even though we only put in maybe $250,000, $300,000-400,000 in a deal. We can easily lead a $2 or $3 million round because of a bit because of our reputation and a bit because of our ability to syndicate. So it puts us in the realm of putting up a term sheet. It gives us typically board representation, and we get the usual investment rights, follow-on investment, anti-dilution protection, information rights, etc., that are pretty critical for angel investors. For any of you who rode through the 1999-2000 bubble in high-tech investment, you'll remember what it was like when all these companies went out for capital in 2001 and every round was a pay to play. That's when angels, I think, really realized, hey, wait a minute, we better organize and figure out some way to deal with this, or we're going to really get crushed down by the big guys. So those are the two major differences, is the sector focus and then the style of investing. We only meet, or a little bit, you can see the contrast, for example, to what Jordan said. We only actually have 5 what you would call general investment meetings a year. We do have 4 meetings a month where the group screens deals. And so what we try to do is spend most of our time screening deals to get to dinner, so that we're not saying necessarily that every deal that makes it to dinner is a perfect deal, but we do pretty much arrange it so that in order for a company to get to dinner, it is an investable deal. We have, at least in our minds, eliminated what we would call the rookie mistakes. There are no obvious reasons not to invest. Having said that, we're in the context of, we're doing A round investments, we're doing seed round investments. We're typically, I think like you are, we're the first money in to a deal. So what that means is not that we're looking for deals that don't have risk. What that means is we're looking for deals where we believe we can identify what the risks are and identify what capability there is to mitigate those risks. And then individuals can make the decision, that level of risk is acceptable to me, or no, it's not acceptable to me. So that's the kind of guiding premise of group operations. So with that, let me stop a minute and just ask, are there any questions on that? Are there any points anyone would like to talk about with that conference?
Allan, I've got one question. How many different sectors does your group get involved in? You've talked about life sciences as one of them. How many others are there?
Well, really the four that I mentioned. We are looking for classic medical devices. We do most medical devices. We're a little bit more shy of implants and class 3 devices that require the PMA pathway. Those typically take 40 to 80 million and 5 to 7 years minimum to commercialize. And so a lot of times the timeline there and the capital requirements don't work for us, but most medical devices do. We'll come back and talk about those kind of large deals in a minute and investing with VCs. Jordan brought up the point that, interestingly, deals that have VC investment actually tend to have worse angel returns. And that's kind of an interesting topic to talk about. Instruments and tools are particularly hot now. The whole kind of pre-diagnostics market, the whole research market in general is really a very interesting place to invest. You've seen a number of unicorns in that area. And one of the most attractive parts about it is a very light regulatory footprint to get those assets to market. Biotech and genomics are very interesting areas. We actually will do biotech investments. This year, I think half of the deals we've invested in are biotech. It's a quite different philosophy to invest in, of course, and quite a different risk profile, as Jordan mentioned at the beginning of this. Essentially, one of this, just to maybe over dramatize the strategy a bit, you're almost using a black swan kind of strategy in biotech investing. Your chances of a win are lower than what would be the case, for example, in medical device or tools investing. But the payoffs on a win are particularly higher. So it's one of those situations where if you pick your portfolio properly, or if you balance your portfolio, you will have a higher percent of losers. But if you have a winner, it will be a 20 or 30x. And so it's an interesting difference in investing philosophy. The fourth category is digital. Digital is kind of off in its own world and has gone through quite an evolution here in the last 5 to 10 years. It acts more, it feels more like software investing, but in the life science sector, it does have some nuances and flavors to it that kind of make it pretty unique all by itself, even within life sciences. And we can talk a little bit more about that as we go and tease out some of those differences. One of the questions that we got ahead of time, in fact, was just in that area. So I will go a little bit more deeply into that.
So if I can just clarify for Barry and for everyone else, Allan's group is called Life Science Angels. So Barry, I think you were asking about sectors outside life sciences. Allan's group is all about life sciences. It's a sector specialist. Those sectors he's been describing just now are the subsectors within life sciences that are of interest.
Thanks, Jordan. You're quite correct.
And so we have the debate is, can you diversify broadly enough within life sciences to actually build an effective angel portfolio? Or must you include other sectors in order to do that? And frankly, there's a split opinion on that. I would say a third of our members do belong to other angel groups, Band of Angels, Tech Coast Angels, whatever, for just that reason, so that they balance life science investments with software and apps and hardware and the other sectors. Others of us feel that within life sciences itself, there's adequate differentiation, but it's a completely fair discussion. So
thank you, Allan.
You're welcome. Let me talk for a little bit then maybe about the state of medtech investing. This has been an astonishing year. 2019 and 2020 have been astonishing in a number of respects, most of which are obvious to us. But one of the really interesting effects has been in life science. The 10 years ago, as near as 10 years ago, 15 years ago, Andy Grove from Intel was speaking at Stanford. And Andy's topic was change in life science. What is it going to take to actually bring the healthcare system into the 21st century? At that time, it was the most under computerized sector of all technical sectors. In fact, the only sector even close to it was education, which was also pitifully under computerized. And Andy thought, yes, absolutely, you can do it. And he gave a very uplifting, positive speech, as you would expect from him. Three Pulitzer Prize economists from Stanford then commented on Andy's speech. And basically they said, look, there will not be change in healthcare without war, national calamity, or economic collapse. And what they meant by that, what they were saying is the budget misalignment that exists, the incredible number of people, middlemen, players in the healthcare delivery continuum that make money off the system are so complex and so well entrenched that you can't crack into the system. Cut a long story short and look forward to now and say pretty much they were right. That actually is true. The biggest problem is this: who pays, who buys, who uses. And what's just happened is some kind of combination of economic collapse, necessity, and literally the dynamite in the room that we needed to provoke change in healthcare. So probably in the last several decades, the most change of any year has been and will be 2020. We are living through a period of time when healthcare as we know it is right on the cusp of what we experienced it as adults growing up versus what our children will experience when they're adults. In 20 years, healthcare will be unrecognizable. And that will be because of what's going on right now. So the message to us as angels, whether it made sense to invest in healthcare or life sciences before, it sure as hell makes sense now. When there's that much change and there's that much uncertainty, and when everything in the system is being challenged at the same time, there's going to be money made. Now the hard part is just going to be figuring out who it is and what we should bet on. So that's kind of the backdrop for this.
So Allan,
yeah,
maybe that's a good moment to address a question from Travis. He's asking, you're talking about assessing the risks and mitigation in assessing a new opportunity. He's wondering what you would consider the three top red flags for a life science opportunity.
So great question. So let's take that and put it in a little bit broader context. So somebody had asked previously, what's the difference between tech investing and life science investing? And I think in some ways, this question gets at the same point. So tech investing is, everyone thinks it's the same thing, that investing in technology and investing in life science are really no different. They're exactly opposites of one another. The way we look at it is technology is all about solutions. The point of a technology investment is an invention, is an idea, is the solution to something that someone's invented or created or discovered. Life science doesn't actually care about the solution. Life science cares about the problem. What's critical in life science is that you have a large enough unmet need that you can build a company around it. Most things in life science, every time one of us goes to our physician or our hospital or has an encounter with the healthcare system, we'll find things that we know can be fixed. So there are needs everywhere, but most of those needs will not support a business that can become profitable and ramp and scale to the degree that investors will make good returns. And that's kind of one of the core differences and one of the core risks. The second one is IP. Life science is particularly hinged on intellectual property and particularly hinged on patents. You can pretty much track exit value and exit trajectories by the strength and scope of the intellectual property protection of the core ideas. So even if you have a great unmet need, and even if you have a terrific solution, if you do not have a proprietary way to protect that solution, you will not get investment money and you won't exit. So the existence of intellectual property is a really, really key aspect of this. Reimbursement, which I mentioned in the lead up coming to this, it really matters who pays. And so many times we listen to pitches where people say, well, there's nobody pays for this right now, but there's the patients are going to love it. And so the individuals are going to pay for it. And then later on, we'll get a reimbursement code. Don't believe that. That does not work. That is a myth. That is a non-viable investment. If you can't find a way to get paid for it pretty straight away, that two things happen. Number one, you're going to have to raise a commercial round. That commercial round is going to force you to build a manufacturing operation, marketing, sales, and have a quality system. That's going to be a very large round. It's going to be a highly dilutive round. And whoever acquires the company is going to have manufacturing, marketing, and sales. So you have just spent a huge amount of money and sustained a bunch of dilution on something that will not actually create value. Moreover, the people who do those rounds have a business model that involves crushing earlier investors off the cap chart. So it puts us in a position as angels to not just worry about our losers, but we actually have to worry about our winners. The more likely it is that we've got a great company, it can really commercialize, but it tries raising those additional amounts of capital, the more at risk we are for running into pay-to-plays or getting participation preferences stacked against us on the way out. So those, I think, would be so you could look at those as risks, or you could look at those as elements of the sector, but IP, reimbursement, and focus on the size of the clinical need are kind of the three core elements, I would say, in life science investing.
Could I ask for a little bit of clarification on the IP? Do you generally think provisional patents ahead of a proper patent are a good starting point? I've found that people sometimes either really, really value them or just say they're worthless. I'd be curious on your views, Allan.
Yeah, no, great question. Great question and big issue, of course. None of these companies have a patent. The most they're going to have is an application or a provisional on file. And so we're going to have to make a bet on whether or not they get a patent. And if they do get the patent, what kind of claims are likely to issue? And are the claims that are likely to issue broad enough to cover what we want and protect the core technology of the company? So a little bit of an art here. Of course, there's no answer to that question, But what we try to do is we will look at the IP. We will not invest without looking at the IP. We've got a couple members in the group who fortunately are patent lawyers or patent agents. And so they understand that stuff reasonably well, and they're able to give us guidance on that. And then you add to it the part called freedom of operation, FTO, freedom to operate. So these companies can't typically afford a real freedom to operate opinion. That can run anywhere from $20,000 to $100,000, depending upon the degree to which you're in a patented field. Stents, for example, you would imagine is a very well patented area. But what you can do is the initial searches. And what we want to see is that the founders of the company and their patent lawyers have done a pretty credible look at what's out there. They've identified the things that are the most obvious threats, in particular, anything cited by the patent office, where they've come back with a patentability issue or novelty issue. And we will look into that enough to form an opinion on are there patents likely to issue, and are the claims likely to be sufficient to protect the idea? Does that answer you?
Thoroughly, thank you. That's brilliant.
Okay, Allan, we have another question. So I'll preface this question by making a point that you may or not be aware of, and that is that certainly in the last 5 years, maybe a bit longer, what we've seen is the US VCs, who traditionally would only invest in American companies, have been more than willing to invest in Australian companies without requiring them to change their jurisdiction in those bigger VC rounds. So now that if we come back to the angel perspective, and Jordan Gruber, one of our guests, is asking, how do you guys at the angel stage, and particularly in life science, how do you look at investing in founders from outside the United States? And also, just as a local question, he's very interested in the Berkeley Skydeck program and wondering if you have a view on that as well.
Yeah, no, absolutely. Let me start with the latter. Berkeley Skydeck has really stepped up. They're so in the Bay Area here, the 800-pound gorilla was Stanford, and everybody wants to invest in things that come out of Stanford, and everybody wants to invest in things that come out of Stanford Biodesign. That's sort of the top of the heap. And so our focus was there. UCSF, which is a huge and complex hospital system in the city, in San Francisco, was for years the birthplace of biotechnology. Almost the entire new campus is aimed at biotechnology, yet, hey, UCSF is a hospital. And so finally, in the last decade, they focused on medical devices and innovation, and they're doing an amazing job in that. And now Berkeley, another one, they don't have a hospital, but they do have access to these other hospitals in the system. And there's terrific work in engineering and science and materials and polymers and things coming out of Berkeley. So they have put together, they've really drawn people from the peninsula, put together a great program, modeled it off QB3 at UCSF. And we work really hand in hand with Berkeley Skydeck. We have great relationships with all of them, and one of our members of our board of directors is one of the leaders of Berkeley Skydeck. Great program. The front part of the question now, that's what happens when I go on too much.
The issue about investing in offshore founders.
Yeah, so I will agree that there's definitely more willingness to invest the way you described, for larger funds to invest in offshore companies and not insist they come to the US. I'm personally a little worried that those might not be the right the right investments for angels. Those funds tend to be larger funds. and in a lot of cases, they tend to have international LPs. There's some great funds in there. There's a bunch of people we know, and they're good people and they're good funds, but they're less protective of angels in general than we hope for. And frankly, one of the things that we're really trying to do, a major thing that we're trying to do, is get out of this with less financing risk. Let me back up just a quick second. Of all the risks in life science investing, the number one risk by a mile is financing risk. So whether there's a need, whether there's a solution, whether there's intellectual property, whether there's reimbursement, on and on and on, if you have every one of those things, but you run out of money, you're dead. And it turns out money is quite hard to raise in life sciences. So the actual risk is the number of times you have to go to the market to raise capital. So you really have to calculate the capital trajectory, cash to exit. We take a real hard look at cash to exit on all of our deals. And to the extent we can, we like to skew that towards at least plausible exits on smaller amounts of cash. Typically, that means accessing the US market. Typically, that means getting US regulatory approval. And so typically the company needs to commercialize in the United States. So we won't, as an angel group, invest outside of the United States, partly for that reason, and partly because I'm sure you guys realize this, at this stage, at the seed stage, 100% of these companies are going to get into trouble. This is so hard. It's just not going to go right all the way through. So typically, we expect that some of our group are going to have to help the companies as an advisor, consultant, a part-time CMO or CTO, whatever, really kind of a hands-on investing look. And we can't do that at a distance. And so our experience has been the further away companies are and the less influence we can have over operational or strategic decisions, the lower our returns. So we're looking at it harder. We do, I was on the phone with Taiwan just before this. We do a lot of deals in Israel, but we do ask that the companies relocate, at least flip a parent into the United States so that the parent, the company that controls the intellectual property and commercializes the product is housed in the US.
Thank you for that, Allan. Can I add to that, actually, as a founder, just from perspective, and it might be useful for the other angels on the call. So I founded Frontier Microscopy back in 2016. We're actually in Adelaide, Australia. And it's been tough. It's been really tough. You talked about financing risks. I've had to work really hard to get the money we need for a small team to build the technology we have. And we've been very fortunate with that, but it feels like we kind of hit a wall there, and to really get the finance we need, I'm looking at the US a lot, and even potentially one program, that SkyDeck program, that I wanted to know a little bit more about. We have to make a tough decision soon. So I really appreciate getting your feedback on that. I think my view as a founder and for the investors in my company, I want to do the best by everyone, and financing risk to be the company we want to be. I feel like it's been great, and we've been able to do a lot more here with a lot less money. But to access real money, we kind of need to make the best of everything. So there's an opportunity. There's a lot of smart people in Australia, a lot of really smart founders. We can't travel. Take the opportunity to angel invest now and help them get to that point where they can really scale up. That's my view anyway. But yeah, thank you, Allan.
No, that's some really important stuff that you're mentioning. I think one of the things that's kind of implicit in what I said is that I think there's probably never been a time where where innovators, founders, and angel investors are more aligned. We angel investors, we really can only make money if you make money. That's not true for VCs, and that's not true for large funds. They can buy us out, they can force us out, they can throw out the founders and the CEO, they can bring in new management, they can give them common stock that dilutes us as angel investors and early stage investors, and they can cram these companies full of money. And you know, how many times have we seen companies where there's $100 million exit, but 85 million of the 100 goes to the last round investor?
Yeah, with a 5 times liquidation preference or something like that.
Right.
I don't. The VC game is the VC game. I see it, but you know, angel investment in Australia is emerging and it's fantastic, but it's a relative thing. I've found when I talk to Australian angel investors, you know, we can make a dollar go a lot further in Australia. We have the R&D tax incentive, we have lower salaries, everything else. We're just as smart, but it's a relative. So a $50,000 investment from an Australian angel investor is more likely going to be a $200,000 US dollar angel investment in the US. And so, I mean, that's just been my experience, but totally, I don't want to, you know, VC game is a very dangerous game to play.
Well, and two things just to follow up on that. Just to be clear, I'm not saying you can't have operations in Australia or operations outside of the United States. That's not a problem, right? If you want to keep your R&D in Melbourne or Queensland or where, that's not a problem. So it's completely okay to have a significant part of your operations at home. We're talking about the rest of it. We're talking about essentially the
commercial.
Yeah, that's going to be the exit that pays the money. So number one, and so just kind of, you know, keep an eye on that. The second issue is I worry a little bit, just to, let's make this a dialogue. I worry a little bit that it is becoming easier to raise money in these other places, but that creates a tax differential. If you're raising money in Australia or Taiwan or Israel or wherever, and if you're taking on investors there, and if later on you need to come to the US and raise a US round, you can't flip the company into a US company. You're creating a tax problem that initially it's troublesome and people don't like it, but it will pretty quickly become unfathomable. People just won't accept it. There'll be so much tax liability as a result of trying to flip the company that you won't be able to flip the company. Your investors won't let you do it. And so you end up closing off financial sources right at a time when you might need them. So I worry about the dynamic a bit. I don't know, Jordan, if you've run into that down there or have any thoughts on it.
Well,
I think we're early enough. You know, it's when he really, I'm lucky my dad's a chartered accountant, so I can ask him about this stuff. But we're early enough to not be valuable enough to, and, you know, we don't operate at a profit, we're far from that, to avoid those tax consequences. But yeah, I totally agree. Like if it's put off too long and you're very profitable, yeah, I mean, you have shareholders and any one of those could potentially cause, you know, bring a flip up to a halt. Yeah.
Yeah, I think on that topic, there's a few other issues. I mean, in Australia, we now have a tax incentive for investing in early stage companies, which works to the advantage of the founders as well as the investors. But of course, if you start restructuring the company, you potentially erode those benefits. So I'd like to just move on. We've got a few minutes left. There's Elaine's been very patient. She's had another question. No, that's great, Jordan. Thanks very much. But there's a related question, which is that, Allan, as you're probably aware, in Australia, we still have pretty reasonable pre-money valuations for our angel rounds. And Silicon Valley has always had higher valuations. Of course, it depends what stage of any given bubble as to how egregious they are. But Elaine's curious to understand from your perspective, how would you handle the fact that a company that got its first angel round in Australia at a modest pre-money valuation, while in the United States, the same company may have a pre-money valuation 2 or 3 or 4 times as large. And I'll just mention that I know one of our portfolio companies is actually currently talking to your group. I'm not sure if you're aware of them, KSM Health, but so they're going through a lot of these topics that we're talking about right now, and hopefully we'll find a way to make it work so we can all co-invest in that same deal. But coming back to Elaine's question, pre-money valuation, disparity in scale.
Yeah. So we have, I don't want to sound hostile to offshore investing. We have invested in companies in Taiwan and Australia and Europe. And so it depends. It depends on the structure. A million, 2 million in a company in a way that doesn't create those tax liabilities that become unsolvable as you get any bigger than that. It depends. So there are ways to get things done. It's just a set of issues that you need to keep an eye on. Valuation wise, I couldn't agree more. I think it's hard to get data on angel investing, but what data there is suggests that if we make money, we'll make money because of early round valuations. We can't, for example, we can't take a flat round after we invest in a seed round or A round. If we take a flat round after that, our chances of ever making money on that deal are very low. We have to get step ups earlier in the investment cycle of a company because we're going to be diluted out pretty quickly, particularly in life sciences. These raises tend to go from 2 million, 3 million to 8 million, 10 million, and then 15 to 20. You're going to get diluted pretty quickly. So you've got to have step ups early on. So you've got to pay a lot of attention to valuation. We probably the number one reason we walk away from possible deals is valuation. We'll do our due diligence. We'll go through that process I described to you. We'll decide that something's investable, and we just won't be able to come to an agreement with the founders as to what makes sense for the two of us, and we won't do it. We won't go forward.
So, Allan, let me just ask for one possible clarification on that. Rather than talking about a dollar number, do you have a general view as to the percentage of the company that you expect your angel round to buy?
A very interesting question. We focus more on the dollar amount than the percentage, but I think when you look at the facts on an investment by investment basis, I don't think there's too much difference. I forget if it's you or John or whichever one of us had said it, but the answer is 25%. On the seed round, we're expecting to get somewhere 25% or north of 25%, 25 to 30%. And these folks who come in and are offering 10 or 15% on a seed round, it's not going to work for us.
All right. And Morris, you had a question you wanted to ask.
Yeah. Allan, given the amount of money that you guys require to go through FDA and whatever, do you guys do a lot of syndications? And do you have your preferred partners? And going back on the question in terms of your offshore investments, you only invest in, or you're suggesting companies should set up a Delaware for you guys to invest in? And is there an issue if you mentioned earlier on about the IP company, if that was in an offshore tax haven, would that be an issue for you guys?
We're wrestling with that. As a matter of fact, there are a couple of companies that we're very interested in that have set up Cayman operations, and we're trying to determine whether or not that's going to work. Part of it is the sort of straightforward structural things that we talked about, just control and ability to influence operations and tax. And part of it is just how does that translate later on at exit? It ties to syndication that you just mentioned. What we really would like to do is work with other angel groups, and smaller venture funds. Typically, you can set your own numbers, but venture funds that are 50, 60, $70 million, under $100 million, they tend to think more like angels. They really can't stuff giant amounts of money into a company. If you're an $80 million fund, typically you're only going to be able to put $5 to $6 million maximum in any one investment. Whereas these big companies can put 10, 15, huge amounts of money. So what we find is that those smaller funds tend to think more like angels and tend to want to exit more like angels. And so we're a little bit more aligned in terms of the exit pathway and how we think the company should be financed. Once you start getting these global firms or international firms or firms above 100, 150 million, you're really taking on a high risk of stacked preferences or other problems on exit.
Did that cover it all, Morris? Great. And look, maybe one last question from Lucien, which follows on from this conversation. And I don't know if we can go all the way through this question, but Lucien's curious how you go about your determination of value and where you're looking, you talked about the size of the problem. You talk, obviously there's the team to consider. And for me, just as a sort of a preemption of this, one of the ways I often answer this question is related to what we were just talking about, which is that valuation in one sense doesn't matter in dollar terms, because if I know that the company needs, for the sake of argument, $500,000 invested, and I know that I want to get, using your number, 25% of the company, then I know that the pre-money valuation has to be 1.5 million. And since at the first round of investment, one perspective is that the company isn't worth anything at all. But more importantly, it's about designing the valuation of the business from the first round forward to be successful, as you were saying. So my answer to that question is always, it's not about a bottom-up accounting arithmetic required, how much of the round that money needs to buy, and is that going to set the company up in a position where it has a credible chance of continuing to grow its valuation, preferably at least doubling every year between the rounds of investment. But how would you respond to that?
Yeah, no, that's this is maybe the most important area in all of angel investing and all of what we do. The importance of the valuation discussion is not just critical in terms of valuation and percentages and returns. It's important in terms of looking into the soul of the founders and the people that you're investing with, and the founders looking into the soul of the angels and the investors they're getting in bed with. These are going to be, if you're investing in the life sciences, you are signing up for a 5 to 8 year run. In fact, to be honest, 5 to 8 years is on the low end. So you are signing up for a long-term relationship. We all know that relationships are tough, and you really need to figure out if you can work successfully together. And the valuation discussion is one of those areas where you can really make a determination of how reasonable is this person, how much are they coachable, how much do we align on our views of the risks of this business, the views of the potential of this business, the possible value of this business. To me, this is just an adult discussion. There's no reason any party should be inhibited or afraid to have a very direct, very blunt discussion on exactly these points. Nothing will matter more to the founders and to us than to come to agreement here. And so when we can't come to agreement, it's okay. People don't agree on some things in life, and that doesn't mean anybody's right or anybody's wrong. But the discussion should be a very straightforward and sensible discussion. Typically, we are looking for deals that are more predictable in their cash requirements, that are more predictable in terms of identifying those risks and understanding whether they're mitigatable, in understanding the exit pathways, the possible exit pathways, what actually is the point at which a company can exit. For example, some of those tools and instruments companies can exit after the B round. They can exit with a certain amount of commercialization proof or exit with a certain amount of revenue growth. Some companies, some medical device companies can exit at FDA approval. Most can't exit until proof of reimbursement and proof of commercial traction. So there should be this discussion. It should go into those details. You should understand and agree on probable cash to probable exit. Then we know what the return scenarios are. We know what the C round investors are looking for. They're looking for 3 to 5% returns. We know what the B round investors are looking for. They're looking for 5 to 10 times return. So we know what we have to look for to add in the cash to do that. So yes, it's not just mathematical calculations, but it should be a consensus building discussion where each side informs the other and where we both decide whether or not we want to work together with the same set of assumptions and expectations.
Thanks. And so I think, as you can all see, we could be, you're welcome, Lucian. We could be talking to Allan all afternoon, but we are coming up to the end. Is there somebody who has a last question they'd like to ask? No? Well, that's all right. That's all right. So as Duncan put in the chat, we'll be circulating a link to the recording of this meeting to anybody who is registered to attend. So if you weren't here for the whole meeting, or if you want to go back and review something that was said, you'll have that opportunity. You're welcome, Quang. And I'd just like to point out that, Allan, we do have here one of the two academics who runs the main biodesign program here in Melbourne. And Melbourne Angels does engage with that program, and we do look at a number of the graduates from that program as well. So it's a great connection from the Stanford Biodesign. It actually went to Hebrew University from Stanford, and then it came to Melbourne via Hebrew University. But we've been running it here for, is it 4 years or 5 years, Quang? I can't quite remember. But anyway, it's all doing quite well for us too.
Biodesign has made such a difference in this whole area. One of the companies we invested in is a wearable neurostimulator for restless leg syndrome. If any of you have restless leg syndrome, you'll know what it is, and most people won't know what it is, but it's a hell of a big market. And there are no approved medical devices to treat that condition. We had a Stanford Biodesign project that we have taken on, we've invested in. We put up about $250,000 of what was in fact a $2.5 million Series A. And they are now doing a $16 million Series B at a $19 million valuation. So it's a really beautiful example of, so far things are going well. We'll see what happens now.
Great. All right. Well, it's been wonderful to see you, Allan, after we've all been apart. There's lots of things coming up through the chat, so we're glad that you've enjoyed the session today. Allan, if somebody did want to get in touch with you, do you want them to come to you directly? Would you like them to ask me to introduce them? What's your preferred approach?
Yeah, it's I trust in the quality of your group, so just feel free to reach out directly. That would be fine.
Excellent. Look, thank you, everybody. It's been a really interesting session. Thank you, Allan, for joining us in your evening. And I wish you all a wonderful weekend. And don't forget, we'll be doing this again at the end of November.
Thanks, everybody, for your questions.
Thanks,
Right.
Allan. Thanks, Jordan.